Welcome to the session, and thanks very much for investing a bit of your time this evening in attending this webinar. This webinar is designed to go for about 45 minutes, and please ask as many questions as you like in the chat. It's designed to be very informative. It's not salesy at all. I'm not going to talk too much about the finance side. I'll run through a high-level overview on the process, but as you'll see throughout the presentation, it's really just jam-packed full of insights and tips and lessons that I've learned along the way with my clients around how you can buy your first home sooner. And we'll talk around the buying process, the boosting process with grants, and also the borrowing process. So hopefully you are a first home buyer if you're attending, or maybe you know one, or maybe you're a guarantor and looking to help out a first home buyer. There's going to be plenty in this session for everyone. As I welcome you to this presentation, it's really such an exciting time if you're looking to buy your first property. My favorite clients by a country mile are first home buyers. It's just such a thrill to work with someone and just be part of that journey when they buy their first property. The excitement that you find that you get when you buy your first home, because you're not just buying bricks and mortar. If you do it correctly, firstly, you're building a foundation for building wealth and lifestyle in your future. And it's getting your foot on the property ladder, but it's really about that satisfaction of owning your own space. It might be potentially buying your forever home and your dream home, but it doesn't happen too often for your first home. But it's about getting some security and maybe about starting a journey with a life partner or something like that. So it's an incredibly exciting time, but it's a really daunting time as well, particularly because you've never done it before. And even people who have bought property, you might only buy property once or twice or three times in your entire life. So it's a process that we don't go through too frequently in life, but it's such an important decision and it's such an important process. And you want to make sure that you're getting all the steps right along the way in the buying journey. So tonight, this is designed to really help you along that process, particularly if you're getting your foot in the door and buying your first property. Because once you do start on the property journey, you can keep climbing the property ladder. So every journey starts with that first step, and yours as a first home buyer is somewhere down the bottom here. You're probably renting or boarding at this point in time, and you're looking to make that first leap into home ownership. And that's your first home. And that's such an exciting part, and that can build the foundation for your financial future. And once you're in that home for a period of time, you're going to build equity in that property. And as we start to move up that ladder, once you build equity in the property, that opens up some other options for you. You might then want to upgrade your home, or you might want to leverage that equity and buy an investment property, for example. And then you might have an appetite to grow an investment portfolio. And what the end result of that is, if we keep moving up that pyramid, is obtaining financial freedom and a legacy to pass on to your family. Getting that first property right is critically important if you have any ambitions in climbing up that property ladder and securing your financial future. So before we get into the thick of it today, I better give myself a quick introduction and a little bit about my story and why I'm sharing. The important part on this slide as well is the disclaimer. So anything I talk about today is general advice only. Please don't take anything specifically that I say today for your own situation. If you do want any specific advice regarding finance, by all means, you can contact me afterwards, but please speak to an authorised professional, whether that's a mortgage broker or someone at a bank, and they will be able to help you. But my story. So I started the Circle Finance Group a couple of years ago, and before I started, I'd had about 25 years in the corporate world, and I'm a qualified financial planner. So I've had a breadth of experience in financial services, and I've bought a couple of houses, I've completed a major renovation. So I have plenty of experience as well in the property market and different areas of property. I bought in Queensland, I bought in Victoria. And I was reflecting when I started the business on my own mortgage broking experience with the brokers that I'd used for buying the properties that I'd bought. And although the brokers that I used were quite efficient, they were very fast at what they did, and they were able to get me the loan and my wife the loan very easily. But one thing I thought was really lacking was that ability of the brokers to dive a little bit deeper and find out a little bit more about our future goals and what we were after in the longer term. And where that really came into play is when we bought our first place in Queensland. We bought with the view that we were going to live there for a few years and then move back to Melbourne at some point in time because all our family's back down here. The broker at the time set the loan up, which was great, but never really asked any deeper questions around our future ambitions and our future goals. And if you would have found out that we were intending on moving from Queensland down to Melbourne in the next sort of 5 or so years once we'd started a family. And by doing that, that asked a few more questions. We may have actually held on to that property when we moved down to Melbourne rather than have us sell it. And that, when we look at property prices now in Queensland, that's probably a $400,000 or $500,000 mistake, because we all know what's happened to property in Queensland over the last period of time. And so when I started this business, I wanted to rectify that. And I think it's the financial planning experience I have and my background in planning that I wanted to start a business that really wanted to dive deeper into my clients' goals and have that ongoing relationship so that our advice can continue to help our clients year after year. And that's what's really important to me and my business. So what we're covering today, I'm going to go through it relatively quickly because there's a heck of a lot of information that I want to get through. But there's 3 key themes that I'm going to run through. And the first is around the buying process. So how to smoothly navigate your purchase. There are plenty of steps along the way and you want to get them all right. And as I said earlier, it's a really daunting process if you haven't done it before. And I'm assuming if you're on this webinar, you're a first home buyer, you probably haven't done it before. So I want to share a lot of lessons that I've learned along the way around how to buy a little bit more smoothly. Then a really critical part is the backing. So what extra backing can you get to help you buy your first home sooner? And in this section, we'll talk around what are the government schemes and government grants that are available, and how does the guarantor process work? It's a lot of people think that being a guarantor is a really tricky area, but it's actually not that complex once you get into it. So I just want to demystify what the guarantor process looks like. And lastly, this is where my world comes into play. We'll talk around the borrowing process and give you some tips to make sure you know what you're in store for when it comes to borrowing and how to ensure that you have a seamless application process so that you can really start looking to buy your property sooner. All right, so if we're looking at the buying process, there's a few steps along the way. And the very first important step in your pathway to purchasing is knowing your numbers. So one thing when we're looking at getting a pre-approval for a home loan, I want you to allow around 3 to 4 weeks for that process. I've had a few clients reach out, say on a Wednesday, and then they want to buy at auction on a Saturday, which just does not leave enough time. Sometimes you can get the loan prepared and approved in time, but usually you need to allow a good 3 to 4 weeks. So why do you want to get pre-approval? Well, pre-approval will allow you to bid with confidence. And it also makes you far more attractive to an agent or the vendor if you are pre-approved. So if you're looking at properties and you've got a full pre-approval, so you're ready to go, the lender's approved and assessed your lending capability and given you that approval, and you're going up against someone that doesn't have pre-approval but still needs to get it, you're going to be far more attractive to the real estate agent and the vendor when it comes to those negotiations, because you've got access to that money a lot sooner than the person you're competing against. So you want to make sure that you're in the most empowered position when you're having those negotiations. So the pre-approval, we go through the application process and the lender will approve your borrowing up to a certain limit. So when we get pre-approval, let's say it's for a sum of $700,000. That means the bank is prepared to lend you $700,000 based on the financial evidence that you've provided. And we give an estimate of the type of property and the value of the property that you're looking to buy. And that means that you've got the confidence that you can buy a property up to that valuation. If you buy a property that's valued a lot less, you don't have to borrow that full amount that you pre-approved for. We recalculate the figures and we reduce that lending amount to usually 80% of the value of the purchase price. Now, pre-approval lasts for about 90 days and it can often be extended once, and that's usually extended it's a pretty simple process by providing a couple of pay slips, confirming that your financial position hasn't changed, and then we can get you another 90 days extension on that pre-approval, after which then you generally have to reapply and do a full application again for another loan. One thing that often doesn't get extended though is if you've applied for any government grants and you've been allocated a position in a government scheme, you often need to fully reapply for those. So I can touch on that a little bit later when we talk about the boosting section. Once you've obtained pre-approval, then the big decision comes into play, which is choosing your property. Now, buying the wrong property can be a disaster, both financially and emotionally. So you really want to get it right. So things to have a think about here. Think about, what are you actually wanting to buy? Are you buying a property for the long term? Or are you buying a stepping stone property, something that you're wanting to get into, maybe only live in it for 3, 4, 5 years, get a little bit of equity, and then move on to something a little bit larger? Are you thinking of buying a property that you're going to flip? If you're really hands-on and you can do up a property, get a bit of equity in it, flip it, sell it, make a tidy profit, and then potentially buy your forever home. Or are you even thinking of rent vesting? You might want to rent in an area that you really like, or you might want to stay with your parents, potentially boarding, and buy an investment property in an area that you can afford and that might have that capital growth that you need over time, so then that you can sell it and then buy a house in the area that you want to live in and move into that house. So one thing that I was told by a buyer's agent a little while ago, the next couple of points are, you really want to test out the neighborhood of where you're going to buy. So if you're buying in the neighborhood where you've grown up, you don't really need to do this, but a lot of first home buyers have to buy in a different area, and it's an area where they can afford. So things like just testing out the local shops, go to the local cafes, check out the local supermarket. You'll get a really good feel for the area by going to the supermarket and a couple of restaurants and cafes if they have them. And a really important one as well is to visit the house that you're looking at different times of the day. The house and the neighborhood can feel completely different at 2 p.m. when you're inspecting the property with the real estate agent and it's dead quiet because everyone's at work or at school. But maybe that road is a bit of a thoroughfare, and between 7:30 and 8:30 in the morning, there's cars just absolutely pouring through the road, or same thing after school. I heard one nightmare situation where, thank goodness the client actually did it, but they went and visited the property in the evening, and then the neighbor in the house opposite was actually just sitting out the front, music blaring, and had a couple of cans of Jim Beam. And they thought, geez, this is a bit ordinary. So they went to one of the other neighbors and just asked, is this what's going on over here? And apparently the guy did it every night. So you don't want to buy a home where you might have some really dodgy neighbors or anything suspect. So take a lot of time to do your research. And the other one is to think of some future needs. To be honest, I think that's one thing we didn't think of enough when we bought our place. But if you're thinking of having a family, think of the local primary schools and high schools. You'll be surprised how quickly time flies once you move in and if you start a family, and when you start into thinking about high school. So don't just think about the local primary school, think about the local high school, and make sure you're in the right catchment zone. And there's sites like On Domain, you can actually search via school zones and things like that. So really refine your search and buy in an area that is going to be desirable for the long term if you're thinking of living in that property for a long period of time. So once you've chosen your property, the next step is to make an offer. And this is quite a nerve-wracking part of the process. And it's going to be a bit different if you're buying a private sale or if you're buying at an auction. So if you're buying a private sale, you can make an offer and you can negotiate, which puts you in a slightly more empowered position because you can negotiate with the real estate agent and the vendor. And you can also include conditions such as subject to finance. So if you haven't got your finance sorted yet, you can still sign a contract, put on the condition that it's subject to finance, and then go away and get your pre-approval. You might have a 2-week time limit to be able to do that. And then if you get your finance approved, then great, you can buy the property. You can also put conditions on there such as a building and pest inspection to make sure that the property is in good order and there's no termite infestation or anything like that. And you'll also get a cooling off period if you sign a contract on private sale, as long as it's more than 3 days either side of the auction. So if you put an offer in before auction, you just need to make sure you do it 3 days before the auction or after if it doesn't sell. If you're within that 3-day period, you actually lose that cooling off protection. Now, the difference that if you go to an auction, now auctions are really daunting and nerve-wracking. I'd suggest you go to a few of them before you actually want to go and bid on your own property, just so you understand what goes on auction day. Now, the auctioneer is going to call for a range of bids and you're putting your hand up and let's just say you win. It's one of the biggest rushes that you'll actually get. I work in a real estate agency in Chelsea once a week, and they were actually the weekend before, the winning bidder actually passed out as he won the auction, which was phenomenal. But that's the type of stress that some people are under when they're bidding. So have a think if you want to do the bidding, or if a trusted family member or friend or someone like that might want to do the bidding for you, because it is pretty nerve-wracking. Now, if you win at auction, you're committed. you can't put any conditions on the contract. There's no subject to finance. There's no building and pest inspection. You are committed to buying that property. You will need to pay a deposit as well, essentially immediately. They'll want you to transfer 10% of the value of the property. Often there's restrictions with online banking and things like that. You might have a $10,000 transfer limit. So you'll need to transfer what you can once you sign the contract straight after the auction. And normally the next business day, you'll have to transfer the rest. So just be mindful of that. That's something that catches a few first home buyers out. Jess, good question. Can you see the auction prior to bidding? You certainly can. So one thing, when you will normally need to register as well to attend an auction, and that's so that the real estate agents know that you're serious. So it's uncommon, and the real estate agents don't like it, for a random person just to turn up at auction and start bidding, because they've got no idea who this person is, whether they actually have finance approved, what the situation is. Make yourself well known to the real estate agent. Get the contract of sale and the Section 32. And that leads into the next point. Work with your conveyancer on these. So provide a copy of your contract of sale and a Section 32 to your conveyancer, because these documents are very long. They make very little sense to you if you haven't seen them before. And get your conveyancer to run their eye over it, and they will call out if there are any issues that need to be called out, any sort of unfair clauses in the contract that you need to be aware of. And they'll also look at things on the title to make sure that the person that's selling the title actually owns the property and that all the legalities are sorted. So absolutely do get a copy of the contract prior to sale and share it with your conveyancer. Your conveyancer is going to be one of the most important people in this process. And then think about extra costs. So what does it actually cost? If you're buying a standalone home, then you don't have any body corporate costs. But if you're buying an apartment or a unit and there's several properties on the one title, then you're going to incur body corporate costs. Now, for an older unit block that doesn't have any lifts or anything fancy, might only be 2 stories, or you might have 6 of those apartments on a massive block that are all individually situated, you're not sharing walls and things like that, your body corporate costs might be quite low, but still they can be $2,500, $3,000 a year. I've seen them up to about $12,000 a year if you buy a brand new apartment in a high-rise building that has a gym, a swimming pool, lifts, all that sort of stuff. So beware of the body corporate costs, and they will actually be in the contract as well. So you'll get a very clear indication of what those costs are. And then also just be mindful of what the property really costs as well. So if you were to buy that property, and let's just use a round figure of $1 million, if the property went for $1 million, you've also got stamp duty on top of that. Now, stamp duty is normally about 5.5% of the property. So that's another $55,000 that you've got to come up with. Think of, you've got building insurance, you've got moving costs, you've got legal fees for your conveyancer, which are about normally $1,700, seems to be about the average fee for a conveyancer. So there's a lot of additional costs that you need to factor in. And it's very worthwhile speaking to, I would suggest, a mortgage broker beforehand, and they can run you through what all those costs are, and they'll give you a few projections based on the purchase price that you're expecting to buy a property at. So once you've made an offer, the next step, hopefully for you, is that the offer is going to be accepted. Now, once the offer is accepted, you're going to get the contract that you need to sign. And typically these days it's done digitally. You may have a handwritten contract if it's straight after an auction, done the old school way. You don't really get a chance to go through the contract again, because hopefully you've already done that because you've done your homework. So you have to sign it. You'll agree on a settlement date, and you'll need to input all the conveyancer details and things like that in there as well. Now, the settlement date, that is actually when the property changes hands and the money changes hands. So if you buy a property today, it's not going to settle immediately. You're not going to pick up the keys day one. Typically what you're going to look at is a 30, a 60 or a 90-day settlement period, but it's really negotiable. You'll have a conversation with the agent and the vendor is the seller, and you'll agree on a settlement date. So it might be 60 days into the future. It gives both of you a comfortable enough period of time to sort out your own accommodation, or you might have to cancel a rental arrangement, things like that, and move. And then in 60 days time, the house settles and you exchange, or you get to go and pick up the keys, which we'll talk about in a second. Now, you do need to pay that deposit to the agent. As I said, they'll generally want it straight away, and it's 10%. So if you're buying a $1 million property, that's $100,000 that they'll want transferred. They'll ask for it all up front. Again, just make sure that your transfer limits with your online banking can do that. Often they'll allow you to put in, say, a $5,000 or $10,000 just holding payment. And then on the first business day, you might have to speak to your bank and authorize them to be able to transfer the majority, the remainder. And then you can do that on the Monday after the auction, for example. So once it's accepted, then you need to step into the formal approval space with the loan application. So you've had pre-approval, which is the lender saying, yes, we're prepared to lend you X amount, but now you've actually bought. We step into formal approval. And what they need for that is a copy of the contract of sale. And that's to verify, obviously, that you've bought the property. And then what they're going to want to do is do a valuation on that property. And that's to verify that the value that you paid is the value that they agree that the property is worth. So usually these are done online these days. Sometimes, depending if it's a complex property or if it's a hobby farm or something like that, they'll want to send an actual valuer out to the property. So the cost of this is covered by the bank. If it's done online, I normally arrange it for my clients online through the bank's website, and it's done in 20 minutes if we do it online. If they need to send someone out, that can take a few days. And what they just want to do is verify that you've bought a legitimate property and that the value of it stacks up, because they're going to be taking that property as security and they're handing over a large check, say it's $800,000 for the loan. And then they want to make sure that the security of the property is a quality security. All right, sorry, just a good question. Why do they value the property when the sale price is the auction price? I thought valuations were done on sale prices of similar properties. Yeah, so what they want to do, Jess, is because they're handing over such a large sum of money, the bank actually is going to have an interest on the title. So they essentially own the property until you pay that loan off. So they want to just validate that what you've paid at auction is accurate according to the valuation of the property. Now, I think what they're trying to do here is just make sure they don't get caught out with any sort of sham sales and things like that. I'm sure in the past, people have tried to sell it to a family member, maybe for much more or much less than what the value's actually worth. So the bank just wants to know that what you paid is a legitimate and an accurate and appropriate price for it. Now, look, I've never seen, when it's at auction, I've never seen the valuation come back differently to what that's been paid for. So I would say 99.999% of the time, the valuation matches the purchase price. So it's more just a formality, to be honest, and a part of the process that we need to go through. They're not trying to muck anyone up or anything. And it's to do with the loan to value ratios. So if you bought a property at $1 million, but they look at it and go, no way, this is only worth 800,000, and you've got an 80% sort of loan to value ratio, they're only going to lend you 80% on the 800,000 as opposed to 80% on the $1 million valuation that you bought it for. That's very unlikely to happen if you buy a normal property at auction. I don't know when that would really happen. Once you've done that, the bank's also going to send you the online banking details so you can start accessing your online banking, and that enables you to set up your offset accounts and maybe credit cards and things like that. It's a lot easier to set up your credit cards if you get a loan with a package that has credit cards as part of the package. It's much easier to do it at application stage. You can also do it later if you don't want one. A lot of people don't want credit cards these days, easier as well. If it's easier not to have one, then don't feel obliged to get one. Once you've got the formal approval, that's almost, as a broker, that's nearly where my job's done, to be honest. It's very quiet from formal approval stage through to settlement. But there's a few steps that you will need to do as the future homeowner. And the next one is to take out insurance. So the bank will put as a condition of the loan that you need to obtain building insurance, and that needs to be obtained before the property settles. So if you've got that 60-day settlement period, within that 60 days, they want you to go to a general insurer, it might be like Amy or Allianz or Budget, one of those, and obtain building insurance. And they want to have their name listed on the policy as the mortgagee. So insurers do this all the time. Once you've done that, you'll get an online copy, a digital copy emailed to you straight away of the certificate of currency, and then forward that to your broker. They'll forward it to the lender, and that basically signs off all of the requirements up until settlement. The other thing that I always suggest to all of my clients here is to make sure that you think about other forms of insurance so that you're fully protected, such as income protection, life insurance, things like that. So I recommend all of my clients speak to a financial planner. Once you've taken on a huge amount of debt, it's time to put our big boy pants or big girl pants on and realize that there's a huge amount of risk there. And particularly if you're providing for a family, or even if you're not, if you're providing just for yourself, if something was to happen to you and you couldn't repay the loan, you may want to consider having insurance there that can step in and help you out if you get into a bit of a bind. Always worthwhile having a no obligation chat to a financial planner about other types of insurance to protect yourself as well. Once that's sorted, the next thing just before settlement is you will have a final inspection, which is often called a pre-settlement inspection. That's normally within the week prior to settlement. And that just enables you to have a walkthrough of the property and just make sure that the house is still in good order. So you don't want to have gone to a property that looked $1 million. And then when they've taken all the posters off the wall, there are huge holes in the plaster and things like that. They've taken all the nice furnishings and the tapware and all the rest of it from the property. Unlikely to happen, but it probably can. It probably has happened. It does happen. And that's why they have pre-settlement inspections. So you can get really good pre-settlement checklists. Just Google them, or your broker can probably provide one for you. Check all the electrics, the plumbing, the fixtures, the fittings, inside and outside, and bring your contract to sale too. Just make sure that if there's any conditions around items that are meant to be staying in the home, or there might be items, who knows, they might have a broken down old trailer or caravan in the backyard or something, and you need that to be removed. If that hasn't been done, take a photo, tell your conveyancer, and your conveyancer will work with the real estate agent and the vendor to make sure that those items are removed before you settle. Then the next step is settlement. So settlement, that's the big day where you actually get the keys to the property. But firstly, what needs to happen is the property needs to transact between the vendor and yourself. So what happens actually at this point in time is settlements are booked in. They always tend to be at 2 o'clock or 2:30 from what I see. And essentially your conveyancer, the vendor's conveyancer, and the bank will essentially all jump online on a system called Hexa. And essentially what they do is exchange the title and pay the funds to buy the property. So your lender will register the mortgage, the title on the new property and provide the funds to buy the property. And your conveyancer will check that all the legal side of things are covered off. And what you need to do is have your contribution available in a bank account. It normally has to be in the lender's bank account, typically the offset account if you've got an offset account. The other options are to transfer it to the conveyancer's trust account. But 9 times out of 10, I would say you need to have your contribution that you're paying in the lender's offset account, and then they will pay the loan amount plus your contribution to the vendor, and then the transaction takes place. And the last step there is you get to pick up the keys. So this is the awesome part where normally within half an hour of the settlement, the real estate agent will have been notified that the settlement went through and everyone's happy. And that means that they can then hand you the keys. So you have to drive to the real estate agency and pick up the keys. And this is the most exciting part because that's where the party starts. You might want to have crack the champagne. Normally the real estate agent gives you a bottle of champagne, have a crack of champagne in the new property. And you also then need to decide what you're doing. I know when we moved into our place, we didn't move in for a few days. We just stripped the house down and gave it a really good coat of paint, changed a few things, like you might want to change the locks, might want to change the toilet seats, things like that. Just make a few changes. You're definitely going to have to do thousands of trips to Bunnings in the first couple of years. I'm still going there every second weekend. Bunnings will be your new best friend, and you'll get Bunnings vouchers for a lot of birthdays and Christmases moving forward. But that's the essential process of buying. One more thing on this one though as well is that when you move, particularly if you've been renting somewhere else, you're going to have to update a whole heap of service providers with your new address. Connect energy, connect the gas, internet, all that sort of stuff. And also, if you're going to change all your banking across, think about updating your direct debit arrangements as well from your previous bank to the new one. Typically, you'll be changing banks if you've got a new home loan. So get your payroll to start paying your pay directly into your offset account, things like that, so you can start paying down the loan a lot sooner. There's loads of strategies that you can employ when it comes to doing that. So speak to your broker or lender around how to pay your loan off sooner and some tips around what you can do with setting up your bank accounts, particularly if you've got an offset or multiple offset accounts, which you can get a lot of the time these days. So on to the next section, which is the backing section, which we want to talk about how you can get into your home sooner. So what I want to touch on here are just a few of the key first home buyer schemes and a little bit around guarantors, and give you an example of how guarantors work. So I usually find that for first home buyers, the challenge is not usually borrowing capacity, it's usually the deposit. So if you're, whether you're single or couple, if you're earning an average wage or slightly above wage, you can generally borrow what you want for that stage of life in terms of your borrowing capacity. But actually saving up a deposit, and normally it'd be 20% deposit plus stamp duty, that is the prohibitive part. Because say if you're buying a $500,000 property, which, let's face it, that's going to get you a small apartment these days, you're going to have to save up $100,000 for the 20% deposit, plus around $25,000 plus for stamp duty, plus all the other costs. So you're probably looking at $130,000, $135,000 of savings, which isn't that easy to do. And that's for a property that's not overly expensive in today's day and age. If it's $1 million, you're going to have to come up with about $260,000 of savings before you can buy that property. So this is where the government grants and first home buyer schemes really come into play, and guarantors. So I'm not going to go through these in intimate detail because they are changing as well, which is the big thing. So the Albanese government, when they won the election, one of the election promises were they were going to open up this space a lot, would remove some of the income caps and remove some of the price caps that they have on properties to be eligible for these schemes, which is great news because it opens it up to a lot more buyers. And the other thing is, I'm not sure what state everyone who's on the call lives in, but the rules are different in every state as well. And the rules are different if you're buying in the city or in regional areas. So I won't go into intimate details on every scheme and grant, but I want to touch on some of the major ones that we see. Oh, this hasn't really worked as I planned, but let me just run through them now. So the first one is you can buy with as little as 5% deposit. And this is with the first home guarantee scheme. So this is a great one. I've probably listed these almost in order of how I see them typically. So what this enables you to do is use a 5% deposit rather than a 20% deposit. And the government is essentially going to guarantee 15% of the purchase price. So that's going to help you save around $20,000 in lender's mortgage insurance. And the reason it does that is because your 5% plus the 15% guarantee from the government means that you're essentially borrowing at the 80% rate. And at 80%, there's no lender's mortgage insurance. So that's going to save you a ton of money and enable you to get into your property a lot sooner. Now, you will still need to come up with stamp duty unless you qualify for the stamp duty waiver. So the second one I want to touch on there is the stamp duty concession or waiver. Now, currently as that stands, if you buy a property up to $600,000 in Victoria, you pay no stamp duty on it. So that 5.5% of stamp duty is just waived, which is a brilliant result for first home buyers. I've had a few new nurses that are newly in their career, quite young, and they've bought properties for $450,000, $500,000, no stamp duty. And when you look at the total savings, they've probably saved close to $30,000, which means they're getting into their property a lot sooner. So that's an awesome one. If the property is between $600,000 and $750,000, you start paying a bit of stamp duty, and it's a sliding scale until it gets that $750,000 purchase price. And then anything above $750,000, you're paying full freight on stamp duty at the moment. But a lot of those caps are changing. Let's wait and see what the government rolls out as part of their election promise. The next one is a first home owner grant, which is $10,000 towards a new property. So if you're buying or building a new home, so it has to be brand new, no one has lived in it before, you can actually get $10,000 towards that new property from the government, which is a bit of a kicker. It's probably not going to make the world of difference, but look, $10,000 is $10,000. It's still very handy. The fourth one, which is saving via superannuation, it's called the First Home Super Saver Scheme. To be honest, I haven't seen anyone use this. And the reason behind that, I'd say, is it's a pretty confusing area. It gets pretty complicated. You've got to plan for it well in advance, and you're probably going to want to engage a financial planner or an accountant to help you navigate this process. So what this enables you to do is, because superannuation, that is a concessionally taxed environment, which means that you pay less tax on earnings inside super than you would typically, if your money was invested outside super, which is taxed at your marginal tax rate. So what it enables you to do is actually make contributions into super of up to $15,000 per year, capped at $50,000 in total, put it in super where it can earn and grow at a concessional sort of tax environment. And then you can withdraw that lump sum, including the earnings, and use that for your deposit. I think most people think that it's far too complicated. Most people don't understand superannuation. So that's probably why I haven't even seen one of them. But it is something that's available to you if you've got a long-term horizon before you want to buy. You can do that as a couple. So that 50,000 cap, if there's two of you, you've got a $100,000 cap in terms of the amount that you can take out. So have a think about that. You want to plan on that one pretty early though, if you're going to do it. And my personal view is that the benefit that you get out of that is only quite marginal compared to if you had a good savings plan outside of super anyway. The sixth one is buying jointly with the government. Now, this is a pretty cool one, or the fifth one, sorry. And this is with the First Home Buyer Fund. Now, just good question. You can use multiple options, so you don't have to use just one. I've seen a few people with that first one. The first two would be the two most common that I see. So you use the 5% deposit and you get the stamp duty waiver. So you can double dip on these things. Absolutely. And I think do them while you can, because we all know how our state and federal governments are going. We've got a lot of government debt. At some point in time, these things might change. However, they also know that housing affordability is at an all-time low, and they're doing everything that they can to enable more people to buy houses and build more houses as well. So who knows where it's all going to land, but if you've got the capacity to do it sooner rather than later, it's probably not the worst idea. You can also buy jointly with the government, and this is the Home Buyer Fund. And what this enables you to do, if you've got a 5% deposit, the Victorian government can actually contribute as much as 25% and essentially co-buy the property with you. When I first heard this, I thought, who in the world would want to co-buy a property with the government? But then I had to think and thought, well, you might have a young family and you need a three-bedroom place. You can only afford a two-bedroom place. Really, what would be the issue then of actually having the government come in as a co-buyer, so that it enables you to buy a slightly better place with an extra bedroom so your family can live comfortably? And then you've got a more expensive asset that's also growing in value, and you're going to benefit from that as well. So at the end of the day, you're probably still putting in the same amount of money, you're borrowing the same amount of money, but you're getting a better property for it. The thing is, when you sell, the government's going to take their percentage split from the sale proceeds, and you're responsible for paying all the rates and all the ongoing maintenance and all the rest of it. It's a pretty complicated one. And in fact, brokers can't help with this. We can't facilitate the loans. There's only a small number of banks that can offer that, and you need to go directly to the bank. So if that's something that's of interest, if you look up the Home Buyer Fund, there's a list of the banks there that can help you, and you need to go directly to the bank to get that one sorted. And the last one that I want to touch on is using a family guarantor, because this is a pretty misunderstood one, I find. Now, this is an awesome one for not just first home buyers, it can be anyone. So a guarantor is typically a parent, needs to be an immediate family member. 99 times out of 100, it's probably going to be a parent. But this can again help you get in with a small deposit. I think sometimes you can even do it with no deposit. Essentially what your guarantor is doing is guarantoring the gap between what you can put into the property up to 20% of the purchase price, so that you again attract loan rates at as if it was an 80% LVR. And also you don't pay lender's mortgage insurance. Now, lender's mortgage insurance can be really prohibitive. I had a client the other day, they had a $750,000 loan at a 95% loan to value ratio, which meant they were going to incur $32,000 of lender's mortgage insurance, which is a lot of money that you need to come up with. You can sometimes capitalize it on the loan, which means add it to your loan. Other times you might have to pay it up front. So that's not going to work for a lot of people. So let's think about, if you don't have a guarantor, let's just run through an example. If you've bought a house, and let's say the house is worth $1 million, and you've got a $50,000 deposit, that also means that you've got to pay for stamp duty, which would be another $55,000 on top of that. So that means the LVR, the loan to value ratio, you're going to have to borrow $950,000 here, which equates to a 95% LVR. That means the $950,000 loan is 95% of the purchase price, so it's 95%. And lender's mortgage insurance for this property at that rate would be $43,000, which is a huge amount. So let's just say that this client had a very good relationship with their parents who owned a property and had sufficient equity in that property to help them out. So the parents' house, what the bank will actually do is use a second property as security. And what they're going to do here is put down $150,000 of security. They're not handing over any cash. It's just that the bank is taking security over that property to the value of $150,000. When we combine it with the $50,000 deposit that the client had, means that the total loan to value ratio in terms of the risk is at 80%. You're still borrowing the $950,000, but the risk to the bank, because they've got your $50,000 deposit and $150 guaranteed by your parents, they're going to price the loan at 80%, which means you don't pay lender's mortgage insurance, and you get the added bonus that the interest rate is going to be reduced by about over 0.5%. Because if the LVR is 95%, they charge a premium in terms of rate, so you're going to be paying a much higher rate. If it's 80, it reduces by over 0.5%. And then as you go on, as your loan is valued, as the LVR is say 70%, 60%, you can often get further deductions from your rates as well with lenders. So it pays to keep on top of your home loan and look at refinancing or contacting your bank and just letting them reprice your property. And when your loan to value ratio changes, ask to get on a better rate. So that's an enormous saving. Now, a lot of the time guarantors get a little bit worried and spooked that their house might be on the line, which I think it usually is not that bad. So how a guarantor can be released is when the loan to value ratio on that property drops to 80%. Now, it might drop to 80% because you've paid a lot of money into the loan. Maybe you're in a job where you get some large bonuses and you've been able to put a couple of large bonuses on the loan, and that drops the loan down to say $800,000 on the million property. So you've only got an 80% LVR. You can then remove the guarantor. The other way that it might happen is if your property increases in value. Now, typically over the long term, we've seen properties grow in value, might be anywhere up to 7% in terms of growth. Now, you might only have to wait 2, 3, 4, 5 years for your property to grow from that $1 million. And in this situation, if let's assume the loan stays at 950, you'd have to get the property to be valued at $1.187 million, refinance the loan, get it revalued, and you get an 80% loan to value ratio, you can remove the guarantor. So your parents might only have to be a guarantor for a few years, and then they can be removed. They don't have to be on it for the life of the loan. So it's not as risky as what a lot of people think. The worst case scenario is if you've got a guarantor, the person who originally took out the loan can no longer pay it off. You're going to have to be responsible for paying the loan down, but you might only do that for a few months, sell the property. If the property's sold, the bank gets paid out, and then you're no longer a guarantor as long as you sell the property for as much as what you bought it for. Is a guarantor loan in parents' name and have to make payments to it? No, so they don't, that 150,000, that's not actually a loan that the parents are taking out. They're just guaranteeing $150,000 worth of equity on their property. So there's only one loan, which in this case would be the $950,000 from the individual buying the property. Parents don't have to take out a loan, don't have to hand over any money. They're just offering $150,000 of security of their home to reduce that LVR of yours down to 80%. So yeah, no repayments are required from the parents unless you can't repay your loan, and then they're going to be on the hook for it for a period of time. But as I said, as long as the property's maintained its value, or if it's grown, sell the property, the bank gets paid out, and they no longer have to pay the loan. So it's not as risky as what a lot of people think. All right, so moving on, we're on to the last portion, which is the borrowing component, and I'll run through this pretty quickly, but there are a few things to get sorted so that you can borrow effectively and smoothly. Most people do need to borrow when you buy a property. So here are a few tips to get your borrowing sorted a lot sooner. Here's how the borrowing process typically works. You'll typically have an initial meeting with a broker, and the broker will then ideally want to get to know a lot about you and get to understand your goals and objectives around the type of property you want to buy, how long you're going to be in there for, what your experience is like with lending and things like that, and possibly do a qualification. So we might do a quick analysis, understand what you're earning, what savings you've got, and then work out roughly how much you can borrow. And if that is enough for what you're looking to buy, then you proceed to the next step. The next step would be then to provide a whole range of documentation to whether this is your broker or whether you're going directly to a bank. Now, the banks want to know a lot about you. They want you to prove who you are by showing your ID. They want you to prove what you earn by providing pay slips, or if you're self-employed, we need the last 2 years business financials and tax returns. You need to prove what you spend, and that's uploading bank statements. We need the last 3 months worth of bank statements. You've got to prove what you owe. So we do a credit check and credit report, providing loan statements, credit card details, things like that. And also you need to prove what you have. So what level of savings you've got. And the bank's going to use all of that, and we need to collate all of that and put it to the bank and package it up in a nice way to get you approved for your loan. The next step is that your broker will research lenders. Now, I'm licensed through a group called Connective. It's one of the largest aggregators. We've got about 50 different lenders that we can look at. So the advantage of going to a broker as opposed to a bank is that brokers will have dozens of lenders that they will be comparing and loads of products. Whereas if you go to a bank, you've only got one. So I would say you're far more likely to get a better rate and a more customized loan product for you if you go to a broker rather than directly to a bank. So we'll do all our research and we'll look at who can provide the best rate, who's got the best features that are appropriate to your situation, what are the loan terms that are going to be applicable, and how much borrowing capacity. When I look at there's about 250 different products that we can see amongst all the lenders. The borrowing capacity can vary by hundreds of thousands of dollars. One lender might lend you $900,000. At the other end, someone might only lend $450,000. So there's a huge difference, and you want to make sure that you're getting the right lender that can lend you what you need. The next is we'll provide a recommendation. Now, a broker is always going to provide you with their top 3 options and then justify why they reckon that the one that they've provided is the most appropriate. Once you agree to that and it's been fully explained to you, we then apply to the bank for pre-approval. And as we talked about before, once you've got that pre-approval, that then allows you to bid with confidence and make an offer, and you can be really certain that you're going to get that money from the lender. Once you've bought, we move into the formal approval stage. Once you provide the contract of sale, then we move into settlement. We've talked about this in the other section. So the settlement's essentially where the transaction takes place. And then what you'll get from a good broker is ongoing support. So you want to have something like an annual review process with your broker so that they can check the rate that you're paying is still competitive. One thing that I didn't realize until I became a broker a few years ago was that brokers can jump in behind the scenes and request a rate discount on your behalf. That never happened to me when I was a client. I was a bit annoyed when I found that out. So something that we do is every year we make sure that we try and reprice our clients' loans so that they're always getting the best deal. So why would you use a broker? And this is not a selling point for me. This is just brokers in general. Brokers now write about 75% of all loans written in Australia. I think proof is in the pudding that people understand the value that a broker can provide. And it's because brokers can compare multiple lenders and products, will explain features and costs. It can guide you from the pre-approval process through to picking up the keys. And the thing is as well, there's no cost to you. So lenders are paid a commission. It's a pretty standard commission across the board. So commission shouldn't influence any broker as to which lender they choose that's most appropriate for you. And the banks pay that, and we can get the same rates, if not better rates generally than what you'll get if you go to a bank directly. So there's really nothing to lose if you go to a strategic broker. The other thing that you want to think about, as well as going to a specialist mortgage broker, is building out your team. Here are the other people that might be a part of your buying journey. So I've talked about a conveyancer. Sometimes it's a solicitor. They've got typically a legal background, and they'll run through the contracts and help you actually physically with the legal parts of the purchase. The next one is a buyer's advocate. If you're struggling to find a property and you're really overwhelmed with the whole process, a specialist buyer's advocate might be someone that's worth considering engaging, and they can do the property searching for you. There's good buyer's advocates and there's not so good buyer's advocates. So try and go to one that is recommended. I've seen a lot of buyer's advocates that might have 3 months ago been an electrician and then decide that they know a bit about property and become a buyer's advocate, and they're charging $20,000 for property advice. So you want to make sure you're going to one that's got some good experience and has got good reviews. Really get to know your real estate agents, which is the next one, and make them your best friend. They've got a lot of off-market properties. Typically, there's a whole heap of real estate agents within each agency as well. So don't just know one, because they've all got their own properties and their own sort of portfolio that they're trying to sell. Make sure that you speak to all the agents in all the agencies in the area that you're trying to buy. And if you're unsuccessful at auction and you're the underbidder, so that if you come second, essentially, make sure you let the real estate agent know. Say, look, I'm the underbidder. I'm really keen. If you've got something else like this, they might just have a property that they're speaking to a potential seller with. And if they know that you're a red hot buyer, they can put you in touch. You might be able to get it before it goes to auction. You just never know. So yeah, really keep in touch with your real estate agent. You probably want to get a building and pest inspection. My theory is if you're spending hundreds of thousands, if not millions on a property, spending a few $100s to make sure that you're not buying a dud property or a lemon is well and truly worth the money. So get a building and pest inspector. We talked about the importance of a financial advisor, particularly to help with insurances and things like that. You're also buying a really expensive asset, so it might be worthwhile looking at your other assets like super and any shares and things like that to make sure that you've got the right balance in all of your assets. And lastly, it's a really good idea to have an accountant, particularly if you're buying investment properties down the track. You want them to be across what you're doing, and they'll be able to provide some guidance around structuring and ownership of the properties and things like that. So in the last couple of slides, if I can summarize my tips for speedy borrowing, make sure you've got all your documentation prepared, prepare it early. I find the biggest delay when I go through the process with clients is clients taking weeks to get their documentation together. So if you've got all that ready, like your pay slips, your ID, your bank statements, things like that, and you can provide them to your broker or lender directly very quickly, you're going to get a much more efficient process. Make sure you close or reduce credit cards or other debts. If you've got a $10,000 credit card, a card with a $10,000 limit just sitting there, that's going to reduce your borrowing capacity by about $50,000. For every $1,000 of limit on your credit card, even if you don't use it, it reduces your borrowing capacity by about $5,000. So if you're not using them, get rid of them if you need to borrow more than what you might be capable of. Next one is think about reducing your discretionary expenditure. Banks will want to know what you're spending. And if you can be a little bit more modest in your spending in the 3 to 6 months prior to, at least 3 months prior to applying for a loan, that's going to help you maximize your borrowing capacity. The next one is just save and save some more. The greater your deposit, the less you need to borrow. Obviously, that means the less repayments. It might mean a lower loan to value ratio, which means you get a better interest rate. So save as much as you possibly can, and that's going to either enable you to buy a better property or borrow less and save money in the long term. Maintain a good credit rating is really important. You can jump online and just Google free credit rating check. There's sites like Equifax, Experian, and Ilion that you can jump on, and some of those will enable you to do a free credit check. And just make sure, the amount of times I have clients that have a buy now, pay later or a store credit card that they didn't even know they had that'd been sitting there for years is unbelievable. So make sure you get rid of all those outstanding liabilities that you don't even know you have. Last one is make sure that you've got a really good buffer to manage risk. And by buffer, a cash buffer. So have a lump sum there, like some emergency savings. I normally recommend at least 6 months worth of loan repayments saved away in your offset account. That's going to reduce a lot of stress just in case you change jobs or you get made redundant or who knows what. And the other thing is have a cash flow buffer. So don't necessarily borrow the absolute maximum just because the bank's going to lend it to you. Think about borrowing a little bit less so that you're not chewing up 50% of your income in loan repayments, which is going to mean that you've got a pretty stressful time in terms of managing your cash flow. So have that cash sort of lump sum, and the cash flow buffer is really important. So that pretty much wraps it up for the presentation. Really appreciate your time and investing your time on a Wednesday night. If you're in Melbourne, it's pretty cold. So hopefully you've got a nice hot cuppa with you and you can jump on the couch and watch a bit of Netflix in a second. But buying your first home is not just a purchase. Think of it really as that strategic move towards financial independence. And the thing is, you don't have to do it alone. So make sure that you're getting the right advice from the right people from the similar professions that I talked about on a slide a couple of slides ago. If you want to buy or even just run through a complimentary strategy session, just scan that QR code and feel free to book in a meeting with me. The first meeting, or all the meetings essentially, are complimentary. There's no downside to booking in a 15-minute or a 30-minute chat to just identify your borrowing capacity and what are the steps that you need to think about that's relevant to your own specific situation. If you want to scan that QR code and book in a meeting, please feel free. Always happy to have a chat and stay in touch. Here are all my contact details. My business, it's myself and I have a support person as well. So we're a small boutique business. We like to add a lot of value to our clients and spend a lot of time with them up front and ongoing. So here are my contact details. I'd love a follow on Instagram if you want to look us up, or LinkedIn. And if you've got any questions, I know we've asked a few throughout the session, but now's the time to do it. But if you don't, I really appreciate your time and I'll let you go. I'll send you an email tomorrow with the First Home Buyers Guide as promised, as a thank you for attending. And that will have all my details on there as well. But feel free to give me a call, give me an email, flick us a note on social media, whatever you like, always open to having a chat. So hopefully you got some value out of that, and I'll see you later if there's no more questions coming through.